of your day to listen to us, and we appreciate your support. For those of you who may not know about Succession Resource Group or worked with us before, we were founded in 2012 by David Grau Jr., and we've grown to over 15 employees. We currently work exclusively in the financial services industry, focusing on independent financial advisors, RIAs, OSJs, CPAs, and insurance practices. Our expertise is focused on 5 key areas: valuing, improving, protecting, growing, and exiting your firm. We take a customized, hands-on approach to problem-solving the pain points in your business so you can protect your key asset. We are the only firm in this industry to present data on transactions that we work on directly, and we publish that data annually to ensure that you stay informed. Today, the 3 presenters are going to be myself, Kristen Grau, Nicole Frey, and Parker Finot. All of our data deal that you're going to see today is going to come directly from, again, transactions that we worked on for the first half of 2022. On our agenda, we're going to talk to you about the state of the market and deal trends in the first 2 quarters of 2022, some sell-side observations, evaluation overview, organizational trends, and then we're going to dive into what we believe our predictions are going to be for the second half of the quarter, as well as addressing any of your guys' questions. With that being said, we're going to kick it over to Parker.
Thank you, Kristen. Hello, everyone. My name is Parker Finot, and I am the Senior Project Coordinator on the Mergers, Acquisitions, and Succession Planning team. Today, I'll provide a brief update on trends and data we've observed in the M&A space during the first half of 2022, and I'll provide context on how these findings relate to our most recent full year 2021 review. Before we get into some of the finer details, I will share a few interesting and high-level observations we've made based on recent activity. First of all, seller exit timeframes are shortening. Some of the primary drivers are market anxiety, business owner fatigue, and a perceived shift in the competitive landscape. These factors are driving sellers to faster action. We've even seen deals being pre-communicated or even exchanging payments before the deal has been signed and sealed. Certainly 2 pitfalls that should be avoided. Additionally, close to 50% of sellers are taking on additional responsibility beyond just the client transition after the sale. One motive driving this trend is the ability to monetize the business while also stepping back from ownership responsibilities. Next, we're seeing traditional mergers and informal partnerships on the rise. Regarding the traditional mergers, advisors are seeking methods for greater efficiency, resource management, talent retention and attraction, as well as a more effective way to cultivate and transfer value. Nicole will be touching on some of those concepts pertaining to these types of transactions later in the presentation. Also, informal partnerships are on the rise for sellers looking to take chips off the table and or for shorter-lived alliances. To that end, fractional interest purchases have had a strong showing thus far in 2022, equating to approximately 1 in 4 SRG facilitated deals, up from approximately 1 in 10 in 2021. Now that we've talked a bit about the trends, let's take a closer look at some of the data. Although the broader markets and economic forecasts have encountered greater volatility as of late, the same has not yet been seen within several key deal statistics. Average down payments have increased modestly from 72% in 2021 up to about 74% for the first half of the year. The usage of clawbacks have remained relatively static, increasing 1% to 48%. But in order to take that a couple clicks down, let's talk about some of those underlying components. The average clawback threshold, wherein what's measured in terms of what was retained, has creeped up from 89% to 91%. This move is in the buyer's favor because the higher the threshold is, the faster attrition is recognized, and then a purchase price adjustment is triggered. Additionally, the type of clawback that's being used is shifting more from a revenue or asset-based mechanism to a client-based mechanism. With greater market volatility and uncertainty, we see more of a shift in this direction because the client-based adjustment mechanism is meant to take the market out of the equation. Next, the observed deal size in 2022 thus far has increased to 137 million from an average of 102 million of AUM being sold in 2021. Some of the contributing factors here are larger businesses that are looking to de-risk, capitulation of holdout sellers that have sat on the sidelines up until this point, and just general market activity. Lastly, all cash deals are trending up from 36% in 2021 to 43% in 2022. Next up, we'll break down the average down payment and see how external financing influences the equation. So first off the bat, you will recognize the 74% metric from the prior slide. Beyond that, we do see a notable yet expected increase to the average down payment when external lending is utilized. In this case, 77% as compared to 64% without external lending. This disparity aside, these proportions have moved closer in line with each other recently, up from 57% on the no external lending side and down from 82% on the external lending side. A couple additional points here in regards to deal structuring and down payments. While higher down payments are typically preferred for many sellers, some do prefer receiving payments for the business over time, either through a seller finance note, contingent escrow agreement, or another mechanism as a means for spacing out the taxes. Conversely, we've also seen sellers that are receiving sales proceeds over time work with their CPA to opt out of the installment sale tax treatment of their deal in order to avoid potentially higher capital gains tax rates that may be enacted in the future. In those scenarios, the seller would pay capital gains tax on the full amount of the proceeds to be received during the year in which the sale occurred. To draw that out, if capital gains rates did go up by some amount, perhaps moderate, they may have earned themselves a bit of a net benefit there, but it is a risk and a bet that's being made in that occurrence. To round out our focus on deal financing, let's review the usage of bank financing in greater detail on the next slide. So here we see about 55% of the transactions were funded through banks or external lenders thus far in 2022, down from 60% seen in 2021. Of course, the rising interest rate environment may continue to shift this allocation. So we'll see that play out in the deals to come. But something else you'll notice here is next to seller financed, we do have other listed. Some of those other payment methods include earnouts, if you can believe it. Those still exist. They are still technically possible. It just depends on the situation and, of course, the seller's preference. We did see a couple of those thus far in 22 and one in 21. So pretty sparse, but they do exist. We've also seen exchange of equity in a buyer's entity to a seller so that they can benefit from the growth and prosperity of that firm into the future. We've seen performance payments wherein different asset revenue, clients, retention, growth rates can be used as hurdles wherein additional payments are made in the future. And then also for more complicated deals, we've even seen things such as entity liquidation rights that grant that person rights to the liquidation of the entity, not outright ownership distributions throughout the time frame. With that, we can move on to common exit strategies, which I see we are on. So in light of the recent trends we've seen pertaining to seller timeframes, seller roles post-sale, increased usage of partnerships, thought it'd be useful to provide a quick overview of common exit strategies. So the first one there, sell and leave, I'm sure you're all quite familiar with, but one thing that we do come across with some sellers is sometimes they don't realize that as a part of that strategy, most of the time there is a client transition period that's expected to substantiate the value. Of course, there are deals that have either no consulting period or extremely limited consulting periods, which we are seeing a bit more of a shift towards, but there is typically some expectation there to support the price. The next option there, selling and being retained. So this again just goes back to that trend we've talked about, wherein folks want to monetize the business and also simultaneously shed the headaches of being a business owner, but they're not ready to necessarily leave the industry. They might love their clients. A remote buyer might opt for this in order to have a satellite location that has full staffing and the ability to take care of itself. For the third and fourth options there, selling tranches internally or externally, these can be accomplished a couple different ways. First of all, you can carve off a portion of the clients that either no longer fit your practice or maybe better suited with another advisor and sell off that specific set of clients. Alternatively, you can monetize a fraction of the ownership interests across the entire book of business, all of the client relationships. In that scenario, we advise those folks to pursue a partnership or some other form of an entity to govern those shared ownership interests going forward. And then finally there, I'm sure you've all read it already, but dying at your desk, we've all heard of this one, and we certainly would not advise taking this option without an extremely lucrative contingency plan in place. Now that we've covered some common exit strategies, let's take a look at the big three tax allocations as they've changed in 2022. So when we're talking about the tax allocations, first we're going to focus on asset sales, which are the majority of the transactions seen in our space, and then we'll move into the equity sales. For asset sales, the average tax structure across, again, the big three, so personal goodwill, consulting support, and restrictive covenants have shifted slightly. And in that, we see for personal goodwill, that has moved up from 93 to 94.5% on average. It's typically something that both parties to a transaction would like to maximize as it's universally beneficial. And so it ends up typically just being the inverse of whatever needs to be allocated to some of these other components. Next, consulting, that has decreased from 4% down to 2% in recent times, primarily driven by, again, that shortening of some of those consulting durations, as well as the everlasting desire to minimize ordinary income tax wherever possible. And then finally, restrictive covenants have ticked up slightly at about 0.5% growth to 3.5% in the deals we've observed in 22. This is really just driven by the desire for a greater chance of enforceability of the contract should there be any breaches or any disagreements. Next, moving on to the equity sales side of things. These equity sales refer to transactions where an ownership interest in an LLC, corporation, or some other form of entity are purchased directly. These types of sales are not as common, just for a couple of reasons. One, the taxability is typically less preferred, especially or primarily from the buyer side. You're going to be establishing basis in an entity, which may provide value and benefits down the line, but it's not going to do much or anything for you right now. Additionally, there's a slightly lower current usage of entities within financial services industry as compared to some other businesses and industries out there. Of course, Nicole will touch more on why and how and when you should be using an entity later in this presentation, so she'll speak on that. Just last note on the taxes here, we've seen about 1 in 10 transactions over the last year and a half that involved some form of entity purchase directly. And one other thing I want to point out here is that just because an entity is being purchased doesn't mean that the buyer is necessarily resigned to strictly establishing basis in that entity. We do see scenarios where a buyer can recognize that 15-year amortization on the purchase, and our team works with advisors to help them understand when that's possible and how to implement that strategy. So with that, we can move on to the next slide here. So now here it is, everyone's favorite topic, revenue multiples. Here you'll see the trends that have developed for both recurring and transactional revenue multiples over the years. You may be wondering why you're not seeing any updated figures for 2022. The reason for that is just because we publish multiples on an annual basis, not on a 6-month basis. And we do that because in addition to our own databases of transactions, we receive comprehensive data sets from numerous sources that are compiled and referenced in order to achieve the greatest level of statistical significance. We understand how much weight these multiples carry, and so we don't want to publish anything that's half-baked. that will affect your retirement or your purchase price. So we want to make sure that we have full and complete data before publishing any official figures. All of that said, everything we're seeing anecdotally and directionally continues with the trends here. Recurring revenue continues to grow, transactional revenue continues to decrease, and we'll share a little bit more about predictions on these types of things at the end of today's presentation. Next, we will take a quick look at the frequency of recurring revenue multiples, as that is, again, the primary driver of value in the financial services business sales. We are referencing 2021 as the most current complete set of data here. And just to break it down into a couple of subcategories, when we're seeing transactions that are less than 2 times multiple on revenue recurring, that's about 17% of the deals. Deals falling in this range are either heavily or entirely transactional based, might have less than favorable business characteristics, and they're being sold without any purchase price contingencies. The next range here, 2.0x times 2.8x. These are slightly below average based on deal characteristics and business characteristics. Similarly, 2.8x to 3.6x, a little bit better on deal terms and or business characteristics, a little bit more risk on the seller side. Finally, 3.6x multiples or higher. These are typically exceptional practices that have contingencies and other terms built into the deal. And they oftentimes have multiple buyers competing for the purchase of that business. That will conclude this slide. And with that, I will be turning it over to Kristen Grau to share her insights on sell side statistics and valuation considerations.
Thank you, Parker. For those of you who don't know me, my name is Kristen Grau, and I'm the Vice President of Succession Resource Group. I work predominantly on our seller advocacy program, or our sell side sellers, as well as on our valuations team. Part of the reason why we wanted to bifurcate or juxtapose sell side statistics against what Parker was previously discussing in regards to one-to-one deals was that while they may be similar in a lot of different ways, right? There's a purchase price, there's a buyer, there's taxation, there's down payments. A lot of the nuances that go into building those deals can vary quite vastly. And so some of the things that we wanted to point out in this presentation were the observations that we made on our sell side represented practices. The first is unlike some of the deals that Parker referenced, where it was one buyer, one seller, our difference here is that for 2021 in particular, it was a 72-to-1 ratio. So 72 buyers for one seller. That particular ratio is staying relatively consistent at this point in time, dropping slightly. And, I think it's often due to market. A lot of times buyers will talk to their clients about having a very long-term view or perspective with their clients in terms of market fluctuation. But when it comes down to actually buying a practice, they're very short-term focused. And so we are seeing a slight dip in regards to the number of qualified buyers in particular relative to the buyer to seller ratios. I think that the key recommendations here is, as a buyer and a seller, really focus on creating a business that someone wants to buy and prepare ahead of time in terms of both what you want to sell, how you're going to sell that, but also what is it that you want to buy. We see a lot of buyers on our My Compass platform that are kind of serial buyers. They're interested in every single acquisition. That usually doesn't pan out extremely well for a lot of them because these sellers are looking for very specific things. So having a good understanding, having a good game plan definitely sets yourself apart, both on the buy side and sell side. Another observation that we've seen is a switch from a strong preference to a requirement, and that is in regards to maintaining a broker-dealer affiliation or a custodial affiliation. A lot of sellers, to no fault of their own, want to avoid repapering, which we completely understand. And in the past, like I mentioned, that was a strong preference. What we're seeing more and more, though, is that is like a make or break. And so I think it's really important to, again, plan ahead, give yourself enough of the high quality, best options in order to move forward, but also be discreet, be quiet, don't overshare. If you're looking at selling your practice, being quiet about it, not sharing that with anyone at all until you're ready to finally sell definitely helps. And the reason behind that is that the financial services is huge, but also very, very small. And inside broker dealers, inside communities, it becomes even smaller. And so if you start to talk about your house, or excuse me, your practice being on the market, right, looking at finding a successor, it's just like a house, where if a house sits for 30 days, 60 days, 90 days, the question starts to become not how great is this house, but what is wrong with this house? And so you want to keep those negative connotations away from your practice. And it's best to do that if you're not shouting from the rooftops that you're looking to sell, and then don't actually act for a year, 2 years, 3 years down the line. I also think that, again, broker dealers, custodians, they are great for securities, advice, and compliance. But a lot of these firms have started to build out succession related services, particularly helping with mergers and acquisitions. I think that they could be a good resource for you, but they shouldn't be the end all be all. And so just keeping in mind, using a third party who is neutral to the transaction can help a lot. Again, similar to maintaining affiliations, a lot of sellers are becoming increasingly specific about their wants, needs, and requirements. And while we believe that these wants, needs, and requirements are key to establishing the best candidate, it also can result in less demand. So less buyers interested in your practice, or less buyers who fit, or check the box for everything. It's usually more time that would be required to fulfill those needs. And oftentimes, if you're looking for such a narrow person to fill your shoes, it may result in less value to you. So I think the key takeaway here is be reasonable, understand what it is you want and need out of this transaction, but more importantly, try to answer the question of what do your clients really need in a successor. And usually that's a high qualified individual who is going to follow in your footsteps. It usually doesn't come down to, the same exact credentials behind their name or a diverse platform. Again, really think about those requirements rather than the wants and needs. Our fourth observation here on the sell side has really been that the seller age has started to decrease. We are seeing younger and younger sellers, which sometimes means that they're less prepared to sell, right? Because of burnout. With 2020, with the market fluctuation, it's been a lot. And people who had a 10-year plan are now shrinking that quite substantially down. And they're just ready to get out of the business. And so that consequently means that their transition timeline tends to be a little bit shorter. Historically, we've seen a transition time that is on average 12 to 18, maybe 24 months, where after the sale, the seller will stay on, help transition the book of business. Now we're seeing that reduced closer to 6 months, sometimes a year. So again, just kind of understanding the purpose behind the sale can tell a lot about what's happening and what's driving certain requirements. Last but not least, our fifth observation on the sell side has really been a lack of internal options. Some of that comes from the fact that, again, we're seeing younger sellers, so those who perhaps haven't developed their team as much. But I think a lot of it also has to do with the Great Resignation, which Nicole will talk about in greater detail here shortly. But the idea is there's a lot of outflow of talent, whether that is due to the employees themselves leaving, or whether that is due to lack of performance from the employees. A lot of companies in the financial services industry and most industries are understaffed. And so there are always companies looking for that next talent. And really, again, it comes down to the lack of plan. So our key recommendation here is make sure that you start early. If you're thinking of an internal succession plan, that oftentimes should start 5 years prior to like actually wanting to be done at the very least. But it takes time. You need to communicate, what it is you want. You need to make sure that the next gen advisors are willing to agree to that plan, that they're willing to take on that additional financial risk. And also make sure that that plan is well thought out. An internal succession plan in particular should not be something that you guys do in 6 months or less, right? It should not be something that you throw together. It really should be a well thought out plan where you start to think about the plan, initiate the plan through a memo, which we do some cash flow modeling and analysis, and then on an ongoing basis, you start to establish and build out the team so that next gen has infrastructure to help support that plan. It's a completely iterative process, and it needs to take a top priority. And then last but not least, if you're not thinking of an internal succession plan, that's perfectly okay. But again, starting early, understanding what you're wanting out of that particular deal, and then building a practice that someone wants to buy, whether that is building a team, those sort of things. Doing a valuation as another example really helps kickstart to make sure that you receive the best value. Next, we're going to talk a little bit in regards to valuation considerations. Again, like Parker mentioned, we're not citing specific multiples at this point in time, again, just because we don't want to cite something statistically that we don't believe it is perhaps as comprehensive as we like. But we do think it is important to talk about some of the valuation trends that do impact value, both on the M&A side, but also internally as well for, contingency planning, for employee buy-ins, all of those things. Valuation is extremely important. So our top 5 valuation trends really have to do with the items that we listed here. And I'll start with the first one. We are seeing revenue growth rates starting to cool. They're starting to kind of taper off, not necessarily decrease, but definitely we're not seeing as heightened growth rates as we did, particularly in 2020. As everyone knows, in March of 2020, COVID occurred. There was a mass pandemic. That first quarter, second quarter was a little bit rough in the financial services industry. But after that, we noticed a immense growth rate start to occur in the second half of 2020, with many advisors having one of their best revenue growth rate years. That growth rate continued into 2021, but is starting to kind of, like I said, taper off and cool down. And we anticipate that to be an ongoing trend, particularly with the market volatility that we're seeing right now. Another trend that we're seeing, again, has to do with the Great Resignation. There is increased staff turnover, lower staffing levels. And what that means is a couple of different things. Number one, expenses are a little bit more sporadic, particularly in the staffing category. But we're also starting to see client to professional ratios become out of whack. So when we're looking at number of households per advisor or number of staff, we're definitely seeing a reduction in the numbers that we didn't used to see before. And that could definitely have an impact to the client service component to the practice, and potentially could start to drive households leaving a particular firm that isn't being staffed appropriately. And Nicole will talk about a couple of ways in which you can prevent that from happening. The third trend that we're seeing is expenses. And this is one that I think will continue to develop as we get into 2023, 2024. But because of COVID, we have seen a substantial number of practices that have that are now officially out of their lease, and or had a lease that was, let's say, 2,000 square feet, and they've cut it in half to 1,000 square feet. Because people simply aren't in the office. They're figuring out other ways to meet with clients, communicate with clients, and service them that isn't being stuck in a desk in a 9-to-5 job at a particular office location. On the flip side, because there are so many firms that are going more virtual, we think and are seeing technology expenses increase to help accomplish some of those efficiencies. So expenses is going to be one that we can continue to keep our eye on and monitor to ensure that we can give you guys the most accurate expense to revenue ratios. The fourth trend is obviously an increase of virtual meetings. Prior to 2020, nearly 90% or more of meetings were being done face-to-face. In 2020, that flipped completely. Nearly all meetings across the country were being done, at least in part, virtually. As we stand today at July of 2022, we're seeing that, yes, face-to-face meetings, in-person meetings have started to ramp back up, but they're nowhere near the levels that they were previously for most practices. And part of the reason is because the fear of having a virtual meeting has gone away. Clients and advisors have started to become accustomed to and like the idea of a virtual meeting, and found that they can service their clients just as effectively. That doesn't mean that face-to-face meetings will go away, of course, but there's definitely an increased push, especially for the younger generation, in the virtual meeting capacity. And last but not least, our final valuation trend here is that we're starting to see, as a result of the staff turnover, as a result perhaps of some of the other factors with the Great Resignation, that more and more firms are starting to hire from within and start to have a multi-owner firm system. That again is going to help with some of those professional ratios, but may not solve for all of the problems that we're seeing in regards to communicating a plan and a real exit strategy, because a lot of the multi-offer firms are still of the similar age. So it'd be like a 55-year-old owner, and then that secondary owner that's coming in is 50. It solves a short-term problem, but doesn't seem to solve that long-term problem 10 years down the line. With that being said, I'm going to kick it over to Nicole, who will talk about the organizational trends.
Thank you so much, Kristen. It's a pleasure to be here. For those of you who don't know me, I am a project manager at Succession Research Group, and my team helps advisors with mergers as well as entity formation and restructuring. We always also help with the creation of employment resources, and that means we set up employment agreements for you, and we establish compensation plans. And we also help with equity sharing plans as well as death and disability plans. The organizational trends that we've been witnessing in Q1 and Q2 of 2022 are mainly driven by external factors. And with that, I mean the industry's activity with respect to consolidation. It's been increasing, as you all might be aware of. And we also still deal with the impact of the Great Resignation. Kristen and Parker both mentioned that. And last but not least, we are dealing with an aging industry that makes staffing levels lower, and it makes it more difficult to attract and retain talent. So because of that, what we've noticed is that advisors, due to that increase of consolidation, also want to keep pace with the market trends and therefore utilize formal entities in a way that expands the use that we have seen historically. As you all might be aware, typically advisors would utilize entities for expense management purposes. However, in recent years, they have expanded that use for equity sharing purposes. And as part of that, we see that reflected in the trend of creating multi-owner ensemble practices. The benefit of those practices is that they have a large pool of skills, knowledge, and experience. They have greater capacities, for example, for acquisition purposes to service a new book of business, and they can increase their market share. So ultimately, those larger ensemble practices can maximize value a little faster, and formal entity structures are great means to put that in effect. And last but not least, the trend also resulted in a greater effort to recruit, manage, and retain talent. As practices acquire additional books of business, it is important to maintain proper service levels. And so it is important to make sure you have the your staffing needs met into the future. Now, if we look at these entity trends in more detail, and if we could move to the next slide, please. We noticed that instead of just expense management, a lot of advisors are forming entities to, first of all, reduce their personal liability exposure. As you operate a sole proprietorship or maybe a general partnership, that personal liability is at maximum levels. And so utilizing an LLC or corporation allows you to reduce that risk. In addition, entities are often formed also for merger and acquisition purposes. They make it easy to enumerate a partner's ownership percentage, and they make it easy to regulate your ownership rights and responsibilities. So these entities have typically comprehensive entity documentation that address how voting has to occur. For example, which decisions are subject to simple majority versus supermajority versus unanimous consent. They also address items like what happens if one of us has to exit the industry prematurely due to death or disability. What if one of us wants to just get out? We don't see the need in this partnership or the value. How do we dissolve this? And so these entities provide a framework in order to regulate those types of scenarios. And they also give you a more formal structure. So as you operate with partners, to make that successful, it is really important to be more transparent and to communicate effectively. And those entity structures oftentimes require partners to meet more formally and follow checklists. We typically help with that so that you address important items. And they also incentivize owners to really look into their financial infrastructure. They oftentimes require that you maintain financial statements on a regular basis, which then translates into setting up budgets and monitoring if those budgets are maintained or are we above or below. How do we allocate our resources next year, for example. So a lot of times formal entity structures incentivize owners to take that next step. And last but not least, potential tax savings could also be an incentive. With that, I mean forming an S-Corp, as you might all be aware. The S-Corp, and I will go into that in more detail, comes with some restrictions. So it is definitely important to consult your tax counsel and parties like us to make sure you're setting up an entity structure that supports you in the long term. Next slide, please. So here you see a quick comparison of the more common operational infrastructures, organizational structures that advisors are utilizing to run their business. The sole proprietorship is typically how you start off. And once your business increases and your risk increases, or you want to implement certain benefits for employees or open yourself up to adding a partner to your firm, that's when we see that advisors start thinking more about utilizing a formal entity like an LLC or an S Corp. The S Corp has the clear advantage that you might end up with tax savings, even though you have to structure that very carefully, because now we also have to make sure you don't open up yourself to more risk from an IRS audit standpoint. And we can talk about how that looks and what you can do in order to reduce that risk. So if you do have an S Corp, feel free to reach out to us so we can have that conversation. However, the S Corp also comes with various restrictions. And depending on what your plan is for your business in the long run, it might not be the best tool for you. For example, for parties who want to engage in merger activities, the LLC provides the ultimate flexibility. It gives you that framework to share equity and regulate your rights and responsibilities. However, it also makes it easier for parties to merge in and to structure compensation to the different partners, depending on what everyone's preferences are. We could advance, please. The following is a very popular structure that we've seen in the last couple of quarters. This is not a structure for someone who wants to keep it simple, whose plan is to have internal succession planning, for example. This is more a structure for someone who really wants to engage in growing more than just organically, growing through mergers and acquisitions. This particular structure is based on 2 tiers, and you can see that the LLC is representing the hub of the organization. This is where you would have all of your operations. So you would have 100% of your business value housed in that LLC, and you would have all of the revenue and expenses in that LLC. The LLC gives you ultimate flexibility. Parties can easily merge in. As Parker mentioned earlier, sales can still be structured as an asset sale from an LLC, and you can decide how owners are going to be paid. In an S Corp, profit distributions have to align with ownership percentages, and in an LLC, you can deviate from that. So sometimes we have parties who would rather track that with production, for example. The second tier here then provides the benefit of the tax savings. So rather than owning your membership interest in the LLC personally, you would own it through a single owner S Corp. And so you would have that tax savings component on that level. Now, next, I'd like to dive into more the teaming trends. And by that, I mean, what are your employment resources supposed to look like if you want to reduce the impact of the Great Resignation and the fact that we're dealing with an aging industry? So if you want to make sure you are highly attractive to people seeking employment in this industry, I recommend that you look at these retention influencers. So when we look at them, and they're based on research that certain companies like the Society for Human Resource Management has done, it shows that Maslow's hierarchy of needs is still real. Employees really look beyond just their basic needs. So you can have a great compensation plan and great benefits. However, if they perceive the culture not as supportive or conducive to performance and growth, they might still look to another office or firm to work there as an employee. And so it's really important to make sure the overall culture is good as well. A lot of employees are looking for connectedness. So isolating them, having them work in silos is not often a great retention tool. So I always encourage clients making sure that you create some sort of team environment with collaboration and communication. If your team members are not always client facing, because your client facing employees do get that naturally because they're engaging with the client. Next slide, please. Here you can see some of the HR resources that we encourage clients to look into. They can result in greater retention rates and recruiting rates. Before you dive into any of these resources, however, it is important to take a look at your business overall and make sure that you create a vision for your business. Where do you want to be with your business in 10 to 20 years? And based on that goal, you would set up an org chart. And that org chart would have positions available that are not occupied at this point. Keep your long-term goals in mind and create the departments and the staffing that you need in order to achieve that long-term goal. And that org chart then can be the basis for the creation of career paths. And those career paths should outline the progression of duties and responsibilities and skills and experience required for each particular job role. And the benefit of having the org chart and the career path for you is that you can quickly see what staffing needs you have. You can see whether or not you have people internally who can grow into certain positions or whether you have to hire into those positions. And for your employees, the benefit is they have a career path outlined for them. It makes it very predictable. They should know exactly what it takes to move up into the next position. Now, with those career paths, you should couple that with compensation plans that are tailored to particular job roles. So a one-size-fits-all approach does not result in the desired objectives or outcomes. So it's really important that those compensation plans really address someone's particular role in the company. That way you can incentivize certain behaviors. The other item that might be good to take a look at is your benefits package. If you allow your employees to work remotely, you might be able to attract more talent if you can expand your search criteria and it's not just within your region. So that might be another way of recruiting additional talent. And last but not least, long-term incentive plans. I will share some more information on that, what we typically do here and what is very popular, but those plans are a great tool for key employees in the firm to incentivize longer tenures and higher performance rates. I mentioned that compensation plans should be tailored to a person's particular job role. And what you see here are compensation components that we often see for advisor level employees. A lot of employees nowadays want some level of certainty. So I see a trend that that is moving away from the eat what you kill type scenario. A lot of advisors, especially younger generations, they want to come in and have some level of certainty with respect to pay. So the salary is still a very important component for them. In order to track that salary, however, with their actual performance, what you can decide is give them a fixed salary for some of their managerial or administrative functions, and then track the rest with the assets they're servicing, for example. So the more assets they can service, the more salary they would receive from the firm. Other important compensation components real quick are individual performance bonuses. You see a variety here that can be used for advisors. However, you can also use special projects as a goal, such as the implementation of a software program or the successful opening of a branch office, and compensate your employees based on that. And then to also make sure they have a focus beyond just their individual performance. Our recommendation is to have some sort of company performance bonus or a long-term incentive plan in place so that they also focus on the company's overall success. Now, looking at those long-term incentive plans, we see two plans that are very popular right now. The equity grant plan provides actual ownership in a company. However, you can make that subject to vesting, and you can also require that as soon as someone vests, they have to sell that equity back to the company. So at that point, then they would receive the financial benefit of that equity. However, you don't have an additional owner in the company. It is pretty much immediately that switch. The benefit of doing this is you can pay this out in cash, or you can pay this out over several years on a promissory note. So this particular plan helps with cash flow or liquidity concerns. The other option is a top hat plan, which is a deferred compensation plan. And our recommendation is to limit that to your highly compensated employees. And that is so you can avoid stringent DOL and ERISA rules. They are just administratively burdensome and very costly. So most of our clients keep it to their highly compensated employees. The benefit of this plan is it is very discretionary. So there's a lot that you can determine throughout the plan. You can even suspend the plan if needed, even though then you take away the initial benefit of that plan. The downside of this particular plan is that the cash award has to be paid out within 90 days of vesting and exercising. So some of our clients come to us and say that creates some concern because we are planning on giving a substantial grant and we don't want to pay that out over time. So at that point, they might switch to actual equity plans. So with that, I'll take it back to our panel for the expectations and predictions for the last half of 2022. Parker, if you want to kick it off on the deal side to let us know what you think is going to change, if there is anything that will change.
Sure thing. Thanks, Nicole. So from the M&A perspective, we expect that market volatility and uncertainty will drive additional sellers that have sat on the sidelines to seek a liquidation event, and will also hasten those that are currently engaged in the process to speed up their deals. We do see fractional interest sales continuing to increase as owners with moderate time horizons seek to further diversify their balance sheets. We expect the trend seen in recurring and transactional revenue multiples to continue. However, we do believe that a potential rebalancing of market conditions in favor of buyers may temper those rates of change in 2022. We do see the rising interest rate environment bolstering the use of seller financing and other financing mechanisms. And finally, we expect a continuation in the trend of industry consolidation based on profitability headwinds, difficulties attracting and retaining top talent, as well as increased owners fatigue. That's everything from the M&A front. How about you, Nicole? What are you seeing in the organizational side of things?
Three trends in particular. One pertaining to the entity structures. I think they will become more and more complex. And the reason for that is that most advisors have particular items on their wish list. And by having those complex structures, they can cross off more items on their wish list. The second item, the second trend that I see is the trend to more in team integration, making sure that you don't have team members that are siloed. This creates more of a collaborative environment and crowdsourcing. So ultimately, value creation. And last but not least, compensation plans that are more tailored for most of our clients. They have team members that hold a hybrid role. So they're not just client facing, they also have some sort of managerial functions. And it's really important to them to keep that employee on board and keep them happy. But that means they have to create customized compensation plans that incentivize all of the different behaviors that they would like that employee to show. Kristen, how about you on the valuation or sell side? What do you see?
Thanks, Nicole. For valuations, we're definitely seeing, based on the deal structure and everything that we're seeing, that there will be an increase in recurring revenue multiples from the 2.83, which we cited in 2021. What that final figure is, we don't quite know yet, but it's definitely looking to be increased. And the transactional or non-recurring revenue multiple is likely going to decrease. It's no longer going to stay steady. So again, shifting businesses away from commissions or transactions is going to help in the long-term value for a lot of firms. Again, as we mentioned earlier, we also see an increase in the use of technology, and having that be a very substantial differentiator, which we do think will allow for increased geographical employees, right? The ability to have employees all over the country rather than just super local, which we've seen more consistently, and that Nicole alluded to earlier. And then last but not least, I think we're going to continue to see sellers who are really looking for synergies in that of a buyer, and really focusing significantly on the fit that brings. Obviously, price and terms will stay a high concern, high priority, but we're seeing, like I said, buyers being very specific about what their wants and needs are in order to move forward with a particular candidate.